In the first quarter of 2026 alone, high net worth individuals, we're talking people with portfolios worth more than most of us will see in a lifetime, lost an estimated $47 billion, not to market crashes, not to economic collapse, to themselves. Most people assume that once you hit a certain level of wealth, you've figured it out. You've cracked the code. You've got advisors, algorithms, and access to information the rest of us can only dream about. But here's what I've learned after 15 years of watching money move across balance sheets. Getting rich doesn't make you smarter. It just makes your mistakes more expensive. And today, we're doing a deep dive into why smart money is hemorrhaging billions to hidden psychological traps. And more importantly, why those exact same traps are probably keeping you poor right now. Because here's the uncomfortable truth. The biases that cost a hedge fund manager his yacht are the same biases that cost you your emergency fund. The scale is different. The brain, exactly the same. Let's break it down. Every year brings new opportunities to lose money in creative ways. But 2026? 2026 is special. We're living through what I call the triple disruption, and it's creating blind spots that even the sharpest investors are walking straight into. The first blind spot is the AI confidence trap. Wealthy investors have access to sophisticated AI-driven trading algorithms. They've got predictive models that can process more data in a second than you or I could analyze in a year. And they trust these systems completely. The problem? These algorithms were trained on historical data. They excel at recognizing patterns that have happened before. But 2026 isn't like before. We're seeing geopolitical realignments, supply chain restructuring, and technological shifts that have no historical precedent. I've seen portfolios worth 9 figures get gutted because someone trusted a model that couldn't predict what it had never seen. Meanwhile, the guy selling hot dogs on the corner who stuck with index funds? He's doing just fine. The second blind spot is the digital asset delusion. The crypto and digital asset landscape in 2026 is more complex than ever. We've got institutional adoption, regulatory frameworks that vary by country, and new financial instruments that didn't exist 18 months ago. Wealthy investors are throwing money at next-generation blockchain projects because they don't want to miss the next big thing. But here's what they're missing. Complexity isn't the same as value. A lot of smart money is currently sitting in assets they don't understand, managed by people they've never met, on platforms they've never audited. The third blind spot is the interest rate hangover. For years, cheap money masked bad decisions. Over-leveraged positions still looked profitable when borrowing costs were near zero. Now, those positions are bleeding. And instead of cutting losses, I'm watching wealthy clients double down, convinced that rates will drop any day now. They're playing a prediction game with their net worth as the ante. Now, you might be watching this thinking, okay, but I'm not trading AI algorithms or buying blockchain projects. How does this apply to me? Here's how. Every single one of these blind spots comes from the same source. It's not about the assets. It's about the psychology. Let me tell you about a client I'll call Marcus. Marcus sold a tech company for $200 million. Smartest guy in any room. Could explain blockchain architecture while simultaneously calculating IRR in his head. Within 3 years, Marcus had lost over 60% of his liquid wealth, not to fraud, not to bad luck, to ego. The first category of psychological mistakes is what I call ego-driven investing. When you've made a fortune, your brain tells you a story. I'm successful because I'm smart. My instincts are better than average. I can see what others can't, and that story becomes a trap. Marcus started overriding his advisors. He bet big on sectors he understood because of his tech background, ignoring that running a company and trading its stock are completely different skills. Every win reinforced his confidence. Every loss was bad timing or market manipulation. His ego wrote checks his portfolio couldn't cash. The second psychological trap is over-leveraging. Debt is a tool. In the right hands at the right time, it's how fortunes are built. But in 2026, I'm seeing wealthy individuals borrow against assets to invest in more assets to borrow against those assets. It's a house of cards built on a foundation of confidence, and when one piece wobbles, the whole thing comes down fast. The average person does this too, by the way. It's called credit card debt. Different scale, same psychological mechanism. The belief that future You will be better equipped to handle the consequences than present. You is equipped to handle the discipline. The third mistake is the sunk cost spiral. I've already invested $2 million into this project. I can't walk away now. Yes, you can. And you probably should. But our brains are wired to protect past decisions. Admitting a loss feels like admitting failure. So instead, we throw more resources at failing ventures, hoping to turn them around and prove our original judgment was right. Wealthy people do this with businesses and investments. You might do this with a car that keeps breaking down, a relationship that keeps hurting you, or a career path that stopped making sense years ago. The psychology is identical. Now let's get specific about the cognitive biases that are bleeding portfolios dry in 2026. The first is loss aversion. Studies show that losing money feels approximately twice as painful as gaining the same amount feels good. This isn't weakness, it's evolution. Our ancestors who feared losing resources survived longer than those who gambled recklessly. But in financial markets, loss aversion creates paralysis. Wealthy investors are holding on to losing positions far longer than they should because selling means admitting defeat. They'd rather watch an asset drop 90% than lock in a 30% loss. Meanwhile, they're selling winners too early to secure gains, missing out on long-term growth. Sound familiar? Maybe you're holding on to that stock you bought in 2021 because selling would make the loss real. Or maybe you've never started investing at all because the fear of losing outweighs the possibility of gaining. That's loss aversion running your financial life. The second bias is status quo bias. Humans prefer things to stay the same, even when change would benefit us. The wealthy are particularly susceptible because the status quo got them here. So why would they change it? I have clients still running investment strategies designed for a 2015 economy. They're not stupid. They're biased toward what worked before, even when all evidence suggests it won't work now. You do this too. That savings account earning 0.4% interest that you've been meaning to move for 3 years? Status quo bias. The budgeting system you know isn't working but haven't replaced? Status quo bias. The third is recency bias. Whatever happened most recently feels like the most important data point. Markets went up last month. We expect them to go up this month. A sector crashed last quarter. We assume it's dead forever. In 2026, this is deadly. We're in a volatile environment where last month's trends mean almost nothing for next month's reality. But brains don't process volatility well. We're pattern-seeking machines trying to find patterns in chaos. So here's where we connect the dots. Every bias I just described, loss aversion, status quo, recency, ego, sunk costs, they don't require a $1 million portfolio to destroy you. They work perfectly well on a $1,000 emergency fund. When you avoid checking your bank account because you're afraid of what you'll see, that's loss aversion. When you keep paying for subscriptions you don't use because canceling feels like losing something. Sunk cost fallacy. When you make financial decisions based on what your friends are doing instead of what your situation requires, that's hurting behavior, the same thing that drives billion-dollar bubbles. The wealthy aren't losing money because they're stupid. They're losing money because they're human, and the only advantage you have over them is this. You can learn from their billion-dollar mistakes without paying billion-dollar tuition. Here's your action plan. First, identify your dominant bias. Which of these traps resonates most with your financial history? That's your starting point. Second, create friction. The best defense against psychological traps is making them harder to fall into. Automate good decisions. Add waiting periods before large purchases. Remove one-click access to your investment accounts. Third, embrace small losses. Practice selling something at a loss on purpose, even if it's just $10. Train your brain that loss isn't catastrophe, it's information. Fourth, schedule regular status quo audits. Every quarter, ask yourself, if I were starting from scratch today, would I make this exact same decision? If the answer is no, you know what to do. Smart money isn't losing billions because the game is rigged against them. They're losing because the same brain that built their fortune is now working against them, and they don't even know it. The question isn't whether you have these biases. You do. We all do. The question is whether you'll recognize them before they become expensive. So here's what I want to know. Which of these hidden biases have you caught running your financial decisions? Drop it in the comments. Let's build some awareness together. And if you want more deep dives into how the top 1% actually thinks about money and how you can apply those lessons without the seven-figure tuition, hit subscribe and turn on notifications. This is where numbers meet human nature. I'll see you in the next one.